Good morning. This is Larry McMillan with a market update recorded on Monday, President's Day, after the future session had closed. It closed on another new high, with the futures up about 20 points or so on the partial holiday session. So the S&P and all the other major indices, Dow, uh, NASDAQ 100, Russell 2000, all making new all-time highs simultaneously. And the momentum was up. I mean, that's all we can really say about that. When support levels start to be broken, then we would become or could become concerned, depending on our other indicators. But right now, the momentum is higher, so we're staying with the longs and just rolling them up, rolling call strikes up and tightening stops on the way higher. S&P has support in theory at 3870, which was the old highs in January. And then we know it has supported 3700. We saw that a couple of weeks ago. And then down at 3630 is the December lows. If those were broken, that would be very bearish, but we're really nowhere near that right now. The put call ratios continue to remain at very low levels. The standard ratio, which measures just volume, is down at levels last seen in the summer of 1999, and it's quickly approaching levels even years before that. So we all know that that was the huge tech bull market going on at that time, and it lasted for some time after the put call ratios were that low. So the fact that they're low means the market's overbought, but until they begin to rise, they're not on a sell signal. So right now, that's they're just overbought on a buy signal, I guess you'd call it. Breadth has been good, and the breadth oscillators remain in very positive territory. They remain on buy signals as well. And the cumulative breadth indicators are also very positive, continuing to make new all-time highs in both the advanced decline line and in cumulative volume breadth. So everything is pretty positive there, but overbought. That's for sure. New highs continue to dominate new lows, maybe by not quite as much as they had before, but new lows are still pretty much non-existent. So this continues to be a bullish indicator as well. Volatility is still operating off the VIX spike peak buy signal from late January, and the trend of volatility is down. The VIX itself closed below 20 for the first time in quite a while. The question now is, how low will it go before things bottom out? I mean, typically, VIX gets down to the 12 to 14 level before we really see problems, but things are a little bit different now with the March bear market so fresh in people's minds. So the VIX futures are a bit of an anomaly and perhaps giving us some warnings. The VIX futures are trading at very huge premiums to VIX. For example, the March futures, which expired in about 5 weeks, are trading at a 6-point premium to VIX. So VIX is 19 and change. These things are 25 and change. That's a large premium. And in one way, it sort of prohibits buying VIX calls as a hedge in case the market drops, because these futures have already got 6 points of rise built into them, and the calls are based on futures, not on VIX itself. On the other hand, there are some sort of quasi arbitrage opportunities there. I'm going to invite you to subscribe to the Option Strategist newsletter if you don't already, because we have a strategy attempting to take advantage of that. So all in all, things still remain quite positive, and we of course would take sell signals if they arise in small size, and then if the market breaks support, we'd increase our size on the bearish side. But for right now, our size positions, core positions, are on the long side. So thanks for listening, and have a great shortened trading week.